program. And one of our SVP and team leads on our 504 team, Jaime Rodriguez here in Southern California, is with us. I also have Ian Aguilar. He is with our entrepreneur ecosystem. So he is helping us out today. I appreciate his assistance. So a couple more people coming in the room, a couple guests. Please join us. Thank you. So we thank you so much for coming. As we go through this, we're going to go through this presentation. After we're finished, these slides will be available. We'll send them out to everybody who's attending, so you do have this as a reference. And of course, it does go without saying that we appreciate that microphones are kept on mute. I think they are automatically muted, so you don't have a problem with that. You may use the chat button or questions. Raise your hand if there's questions in there. We will try to answer as we can, but we will also have a Q&A at the end for your questions. But we do want to keep this conversational, so please feel free to ask questions as we're going along, and you will be unmuted for a question, or you may enter a question in the chat on there. And so, like I said, we will do the Q&A at the end on there. So we will get started on our presentation here. So again, it is a discussion of some things I hear in the market sometimes about the SBA 504 and SBA programs, and it's like, is it quite true or are they not true? So that we'd hit some of those, and then we also get a lot of questions that come up repetitively. So let's just go ahead and discuss some of those. So first thing I'm going to do though is I would like to talk about AmPac. Again, we'll go through some of our programs, go through the truth or myth, our frequently asked questions to be answered, and then we'll do a Q&A for us. So who is AmPac? So we are a 501c3 mission-based lender. We are approved and authorized by the U.S. Small Business Administration, certified development company offering the 504 program, and along with other small programs under the Small Business Administration. We exist to uplift communities, strengthen families, and advance entrepreneurial dreams. What do we do? So again, we provide government-backed loans anywhere from $5,000, and projects could go up to $30 million with our 504 program. So we provide SBA loans under the 504 and small 7A loans for businesses to allow them to refinance buildings, equipment, or for construction and improvements. And we've provided over $1 billion in loans to small businesses since AmPac started lending in 2007. Great time in 2007. We also provide direct loans for working capital, for inventory, business acquisitions, et cetera. And we've lent over $7 million in small loans. So we also provide business advising. We have a lot of lending partners, such as some of you who are attending, and we can help make introductions where necessary for businesses to help find the appropriate lending partner for their financing needs on there. We also provide training programs through our entrepreneur ecosystem, and it could be a leap to launch for businesses that are starting up or looking to launch to that next level. We recently graduated our first class on the leap to launch, and then there's always technical assistance and so forth. We have an app, and we do recommend that if you'd like to be a partner to us, a lending partner that businesses can look up, they may, you may go to your app store and look up AmPac Business Capital and become a partner of ours and enter your information. And again, we provide those direct loans and collaborate with a lot of organizations to advance partnerships for small businesses. Some of our small loans, would be our minority small business loan program, which goes up to 50,000. We have a micro loan that goes up to 50,000. And we also provide small 7A loans up to 350, previously known as the Community Advantage. Ahmed, would you like to say anything about that?
Well, thank you, Janine. So basically, it's a community, it used to be called the Community Advantage Loans up to 300, and it was to $200,000, and then it got increased to $350,000. We provide that it can work for real estate purchase, if it's possible, business acquisition, partner buyout, equipment purchases, or a debt refinance. We have a very wide credit box, so we can accommodate whatever doesn't fit your credit box on your end. We don't require any deposit relationship, so basically we are in it just to boost and provide access to capital to your customers or to our customers. Thank you, Janine.
Great, thank you, Ahmed. So it's a great program. We can pair that with our 504 very well for sometimes for some smaller needs that we just don't want to put into the 504, and maybe our banking partner is not seeking to provide a small loan like that. So we want to be a solution for that. Additionally, one thing that is very unique to AmPac is that we do have two programs that are assisting business owners in making the purchase of their building. We understand there are underserved markets, women-owned businesses, Black-owned businesses, Latino-owned businesses that are not gaining access to capital in the same proportion as other demographics. So we have a program that is down payment assistance in the form of liquidity replacement. So we have two different programs. One would be, as I mentioned, for a business that is 51% or more owned by a woman of any ethnicity, or 51% Black-owned or Latino-owned of any gender. And this would provide a replacement. So of the required down payment, say it's 10% or 15%, depending on the project, this can provide up to 1/2 of that down payment to come back to them after escrow closes, and we can do it very quickly, up to a maximum 100,000 on there, and then that can be used to replace their liquidity for their business operations. So this is in the term of or in the format of a term loan over 10 years, fixed for 5%. It does have a due in 5 years. And for this particular program, there would be no payment due in the first 12 months on that. We also opened that up to be a similar program for first-time buyers. So if a business is purchasing a property for the first time for their business, and that does not have any gender or ethnicity requirements, we're just looking for businesses that by making that down payment is going to drain some of their liquidity. We want to help replace that for their operations. And that everything is the same with the exception of this would have payments starting immediately, no deferment for 12 months. So these are really great programs. And as for you as lenders, you'll like to know that, you know, the borrower is still coming in with their required down payment. So your underwriter will like that. And we are not putting a lien on the property for this loan. So I know that's can be a very good big deal for your underwriters, so you don't have to worry about that. So please let us know if you have questions on that. All right, so we're going to get into some things that I hear out in the market sometimes. I see things on LinkedIn. I have people ask me. I see some articles. And so let's get into figuring out if some of these things are that we hear, is it the truth or is it a myth? Let's go to the big one. Always see this one. The prepayment penalty on the 504 second TD is in place for 10 years, and it is 10% in year 1, 9% in year 2, on and on and on till 1% in the last year. Is that truth or is that myth? And please feel free to put that into the chat if you'd like to. So.
There are 2 people trying to get in.
Yeah. Pardon?
There are 2 people trying to get in the room.
Thank you. On there. Okay, so this is for the most part a myth. So yes, it is in play, there is a penalty in place for 10 years for the 20 or 25-year debenture option. But if you're using the 10-year option was only in place for 5 years. But it is not always 10, 9, 8, 7, 6, 5. So every month that we fund a debenture, the prepayment penalty start rate is dependent on the debenture rate, not the full effective rate. So when I quote to you and I say the January effective rate for the 25-year fixed is 6.36. Built into that is a debenture rate, which is based on the rate of the underlying bond of what we, how we sell the debentures out on the market. So for example, for January, as I mentioned, the effective rate is 6.36. The debenture rate is actually 5.05. And every month that's going to be different depending on what it funds at. So for this example, I just rounded it up to make it easy to a 5%. And you can see that, so on this particular month, that would have been the debenture rate. So year one would be a 5% penalty. Year two would be 90% of that at 4.5. Year three would be 80% of that at 4%, and so on and so on. So if you look at back during COVID, when we had those historically low rates, and sometimes our full effective rate was only 3%, you saw debenture rates that were even below 2. So some of those have very low penalties. Now, could it technically get to 10%? 9%? Yeah, it could, but you'd probably be seeing effective rates around 13, 14%. I can just imagine what the treasury rate or prime rate would be at that point. But so yes, technically it could get to that, but it is not the standard penalty. So a borrower can pay off their 504 second TD only one time per year. Truth or myth? Myth. Okay. Got some answers there. Okay, this is a myth. So if the SBA, or they will accept payoffs one time per month. So it can be paid off in any month, but always on the third Thursday of each month. So there is a more optimal time. And also I will note that you cannot make partial payments to the SBA debenture. So if a payment is going to be made, it needs to be a full payoff on there. So there is a more optimal time for borrowers to try to schedule a payoff. And that would be the month prior to their annual or semi-annual anniversary of their debenture funding. That is not the closing of escrow if it was a purchase. We're talking about when we funded. So if you close escrow in January, and then we go and we fund our debenture in March, your annual and semi-annual anniversary dates will be the March and September. And the most optimal time would be the month prior to that. So it would be then February and August. And the reason of that, it just has to be, if you don't do it at that time, you'd have to pay some additional fees and interest to the next annual or semi-annual anniversary. So if somebody is planning to pay off their debenture, CDCs need to be notified within 15 days prior to the payoff. The demands can't be processed or prepared until the 6th business day of each month because of the way our servicing agent acts in their system. And then payoffs need to come either from, payoff requests, excuse me, should come to the CDC from either the borrower directly, or they must come through escrow along with a signed borrower's authorization, or we need to have the borrower's authorization. We cannot just have the lender call up and ask for a demand. Okay. SBA loans are not available for businesses with annual revenues over 10 million. I think most of us know the answer to this. So that would be a myth. I hear it every once in a while. I might have a more, let's say an experienced banker, lender, or somebody, a CPA who really hasn't worked within the SBA programs for a while, and they still have some previous thoughts about how the SBA programs work. So that is definitely a myth. And so there, well, we have been welcomed by Ms. Hilda Kennedy. There is no gross revenue limit, top line revenue limit on the 504. However, we do have to make sure that the applicant and its affiliates meet SBA size standards to be considered small. We usually use for the 504 what is known as the alternative size standard. And that we're looking at that the applicant and their affiliates have a tangible net worth of 15 million or less, and that the net profit after tax, federal taxes on average over the last 2 years is 5 million or less. And then again, that is applicant and affiliates. Now, there were some changes to the affiliate rule last year. So fewer entities are now being considered affiliates. So this does open up more opportunity for borrowers who may have previously been sized out. Now we're not including some of the ownerships they have in other companies as true affiliates. They may be able to be eligible for additional financing or for financing. Also let you know that those size standards do increase by 25% if the project property is in a labor surplus area. And that's very easy for us to look up and to see. They'd be surprised, quite a few areas are considered labor surplus areas. So that would bring the net worth up to 18.75 and the net profit to 6.25%. And we're looking at the size determination is at the time of the application. So if by purchasing that property is going to move their tangible net worth up above that, we're not looking at it. We're looking at it as they are at the time of the application before making that purchase. Okay. All right, here's another one. A borrower may obtain up to 21.5 million in 504 second TD debentures when using the 504 green program. Truth or myth? Anybody want to comment on that one?
Do I count?
All right. That is the truth. So, a borrower may obtain, when using the green program, each project can go up to 5.5 million on the gross debenture. When I mention gross debenture, that means the amount including our fees that we're going to finance in the final funding on there. And they can have an aggregate up to 16.5 million in green debentures, plus 5 million in gross standard 504 debentures. Now there was a while back, they were really limiting that to 3 of the green debentures. So it didn't matter if it was 2 million or 3 million. They were saying no more than 3, assuming that you could have a maximum up to 16.5. They have loosened that up. So now a borrower could be spread out over more projects. So they have a $2 million one, a $3 million one, a $4 million one, and they don't have to be limited in that respect. So, and just remember for regular standard, it is 5 million. And we do also have to take into account any 7A loans, including community advantage loans, to make sure that they have the eligibility left on that. So on there, okay. So the 504 loan cannot be used to finance ground up construction or special purpose properties. Only 7A loan can be used for those purposes. Truth or myth? That's a myth, yeah. So the reason I put that one in there is that I recently saw on LinkedIn, it was a post, it was actually a published article where a banker had written and stated this, said that you can't use the 504 for construction or special purpose.
Mm.
Now, that might be true for that bank, and that might be true for some of your banks, that you can't do that. But that is not true in the SOP for the 504. We can do that. Whatever properties are eligible for the 7A in terms of owner user properties and construction is available for the 504. So per the SOP, both the 504 or 7A may be used for ground up construction, renovations, improvements of the eligible owner user commercial properties. And they can be special use properties. So 504 proceeds are used, as you know, exclusively for the financing long-term fixed assets. And with construction, that could include your soft costs. We can include long life machinery and equipment, and if essential to, in a minor part of the project, furniture and fixtures could be included. Now, the 504 does not allow for any working capital or intangibles in financing. So that's where the 7A could include some working capital and intangibles such as goodwill if there's a business purchase along with that. So now the 504, of course, can handle larger projects, so it can exceed 10 million, and we've done 25 million and more project sizes with the 504. And of course, 7A loans are capped at 5 million on the aggregate and with 3.75 million in guarantees.
You can also incorporate the green program with the construction of especially or limited use property too. So keep
And
that in
we're gonna
mind.
get more into the green here. I'm going to definitely have you talking more about it because I know you have a lot of experience. with
Keeps
that
me
area.
going.
Yeah. So, Hilda, if you have a moment, I'd like to have you, we didn't have this in there as a question, but here's one. I'd love for you to answer. I'll put you on the spot here. I'm sorry.
Okay.
The SBA 504 and 7A programs are funded with taxpayer dollars. Truth or myth?
The 504 and 7A dollars are budgeted within the federal budget. Why that is a myth is because the 504 and 7A programs pay for themselves. Because of the excellent work that lenders do, I'm going to credit lenders with this in terms of vetting 504 and 7A borrowers and working with those borrowers are paying their loans as agreed. And so there's no loss to the federal government. There's no subsidy that the federal government is paying for these programs. These programs are paying for themselves. So a lot of people have said, oh my goodness, I don't want a government loan. I don't want the government in my business. Well, the government is always in your business. That's a truth. However, what you should be aware of though, is that these programs get no subsidy. Yes, they are budgeted within the federal budget, but they don't get a subsidy because the business owners who are funded with 504 and 7A loans really pay these loans back and pay for themselves. So thank you so much for
Yes.
this question.
And my apologies, if you don't, I think most everybody knows, this is Hilda Kennedy. She is our founder and president of AmPac Business Capital. Hilda is also on the board for NADCO, which is the National Association of Development Companies, a trade association which supports CDCs across the nation. She's recently elected to as Region 9 Director for NADCO, Region 9 being California, Nevada, and Hawaii.
Arizona.
And Arizona. So the largest, most highly producing region in the country. So we really appreciate having her on that. She gets a lot of great information and is able to have a lot of leverage over our industry with that. So, okay, so the next thing we're going to go to, because we've collectively on our team come together and talked about some of the most frequently asked questions we receive on the 504 and SBA programs in general. So we're going to start in with that. I'm going to start with an easy one here. And that one, I still get a lot of questions on that. What is the maximum loan to value on a 504 loan? And it's pretty much the same for a 7A. So if we're financing, the purchase of a multi-use property, thinking a warehouse or an office, something that has multiple uses, we can go up to 90%, under the assumption that the business has been operating for 2 years or more. Also, let me explain, when we're talking about 2 years, we're talking about operating, not just from when they formed the business, but generating revenue. That's what determines when they started their business. If the property is a special use property, such as a gas station, a hotel, car wash, assisted living, such properties, then we're going to have 85% maximum on that borrower designate to contribute that additional 5%. If the business is a startup, meaning generating revenue for less than 24 months, as I mentioned, that would also be 85% maximum loan to value. And if it's both a special use and a startup, then 80%, the borrower would come in with 20%. Now, want to talk to you a little bit about, because we've been seeing a lot of change of ownership, businesses being acquired, either what we're working with now, or maybe they recently acquired one and we're doing a refinance. So an applicant may be considered a new or startup business, even if they are acquiring or acquired a business that had been operating for many, many years. If that buyer didn't have relevant ownership experience. So if that change of ownership resulted in unproven ownership and management, and they had increased debt unrelated to the operations, that could still be considered a new business. So I've been in lending for 30-something years, and maybe I own a laundromat on the side, but now I'm going to go buy a florist shop. Well, I've never owned a retail business. I've never worked in the floral business. So even though that florist shop might have been operating for 20 years, I don't have the experience. It's going to be considered a startup. So it's pretty strict on that. So we just always have to be prepared for the additional down payment in situations like that. Okay, how much of the property does the SBA require the applicant to occupy? So if we're financing a building that has already been constructed, then you need to occupy a minimum of 51% of that, and you can lease out up to 49%. Please note that if that property that is being purchased or refinanced includes multiple parcels or even 2 adjacent condo units, because they're separate APN numbers, you must occupy a minimum of 51% of each parcel for each unit on that. So that sometimes can be an issue. And believe me, we have gone down the road of trying to get that exception. Not happening. So if the property is new construction, meaning we're financing the construction of the building, and that could be ground up construction, definitely, could also include a major renovation that it is drastically expanding the footprint of the building, could also be considered in that. So we require the business owner is going to have to occupy 60% immediately upon occupancy. They can lease out up to 20% long-term and temporarily lease out another 20% with the goal to be at all of 80% within 10 years. So certain types of properties, we have to demonstrate that they're going to be able to expand into that other 20%. So if we have a retail building down below 60%, and you've got residential units up there 40%, that's going to be, that's ground up construction, that's going to be hard. How are we going to demonstrate that they're going to use that for their business? But other types of properties, we can do that. So, and then just to let you know, when it comes to rentable property, how we can help make that 51% or the 60%. So when we're looking at that, the total square footage of all buildings used for the operations, and we can include some common areas. So like the lobbies and passageways, shared bathrooms, kitchens and break rooms, vestibules, Those are common areas used by both and maintained by the operating company, our borrower, then we may be able to use those. We cannot use just general parking lots out in the back. Outside, we can't just use that. Neither can we use stairways, elevators, or mechanical areas. Now, there's a time we could use exterior space when you think about businesses that do use them for their business, such as a storage yard for contractors, trucking companies, moving and storage. If it's a business like boats and marinas and so forth. So the CDC just must document why they're including that as rentable square footage. Okay, may a borrower obtain multiple 7A and 504 loans? Ed, I'm going to let you talk about that one because I know you have a lot of experience with your borrowers in that.
Well, the answer is yes, especially with the green program. I've had one business where the initial loan was to acquire a piece of commercial real estate. And so they used some of the 504 money for that. They came back within a year and wanted some heavy equipment. They used the 504 for that. And then they came back year after year for basically the last 8 years with expansion because of equipment and updating their systems. So when we started to hit the $5 million max under the regular cap, we looked, the interest rates were such that they refinanced the commercial real estate at a very long-term, nice fixed rate, which allowed for more SBA 504 machinery and equipment. So they've been just a great borrower that goes along that way. Another borrower was building an assisted living and used his $5 million cap. Then right next door, he had a memory care unit. And he came back and said, you know, can I get any more SBA 504? I said, of course. We use the green program, and he liked it. With the green program, if you have 15% or more of a sustainable energy contribution, usually it's solar, that opens you up into that program. So we did that project with 5.5, about 5,380,000 net debenture. And then couple of years passed and he came back and said, hey, I have a mirror project and it's assisted living in one place and, you know, memory care in the other. So we did 2 more green loans with him. So literally he had the $5 million cap and 3 $5.5 million SBA greens. So it's a very good program. The other thing that we've done is have another borrower who's in the hospitality area, and he built his own hotels back in the, you know, like 2008, came back and refinanced one of those so that he had more cash because he had entitled another property. We did a ground up construction for a hospitality project in West Sacramento using the green program. So that the green program does not impact the cap on the 5 million. He refinanced one hotel, and we were right in the process of refinancing a second hotel he owned when interest rates spiked. So that kind of went sideways. But the other thing that we can look at is anything with the NICS code of a 31, 30, or 33.
And I'll get to a slide on that one. Talk
All
about
right, then I'll set up. I'm good.
Thanks. So again, we've got some details here about the 7A loan. And, you know, kind of notice when we have a borrower that has 5 million outstanding in 7A loans, I'm only concerned with the portion that was guaranteed. So that does create more for that. So they would have 3.75 million. And even if we're doing standard, I would still have 1.25 million available to play with a 504 without even going into the public policy goal. So on there. So we've got those details here. So how can a business increase its 504 borrowing ability? By meeting those certain public policy goals. So this is the green program on there. So a business and its affiliates may obtain green second TDs up to 5.5 million per project and an aggregate of 16.5 plus 5 million standard 504, as I discussed before. There are 2 goals that they're trying to reach. Either energy reduction, and that would, of 10% of their energy use, that would only be available for projects that are a relocation to a new facility or renovation or replacement properties, because we've got to have a comparison to go back to for that business in their prior energy use. Or we can meet that goal for, they're going to generate more than 15% of energy used on site through a renewable energy source such as solar, wind, geothermal, other types. Of course, solar would be the most common type that we would see. And this could be used for startup businesses. And then, so again, this is a way to increase beyond the $5 million. Now, please know that in each project is standalone, that this does not increase 7A borrowing cap. So once everything together on a 504, 7As are at 5 million, there's no more 7A, but we can keep growing with the 504. Ed, did you want to, anything else with those green? I think most of what you're doing is the renewable, right?
Right. If you're doing ground up construction and there's LEED certification, you can go with that. On something where you're going into a reduction of 10%, that would be like an acquisition, same OC's buying another, light industrial building, and it's very inefficient as to its energy use. If they do something to reduce it by 10%, then they can still go into the public policy for energy.
Great. So again, sometimes talking to a borrower and understanding what their needs are going to be going forward. Sometimes even on their first project, it might make sense to go green because maybe they have another one that it won't make sense for. So if they're going to be a growing business that is going to have multiple facilities, something to talk about whether they want to do that, especially if it's ground up construction.
Janine, one other point on that I also recommend too is, using the right product for the right needs. So when people are comparing, should I use a 504? Should I use a 7A? Really using the 7A strategically for business acquisitions or for other working capital needs is a much more strategic way to use the 7A product versus the 504 product, really focused on the fixed asset. Trying to use your 7A for a fixed asset for purchasing real estate or construction, when you use up that guarantee, when you can use it more for growing the business, is a much wiser way to use the 7A product versus the 504, and being educated about that.
And I think I showed on the back. Oh, yes, Michael.
I'm just curious, are you seeing more requests on the 7A side, just given the interest rate fluctuation? Maybe the Fed's hinting at, reducing rates, maybe more advantageous to do the 7A as opposed to the 504.
Well, Michael's question, if you didn't hear, is if we are seeing more requests for 7A. Well, our 7As are capped at 350. So we aren't seeing that for the purchases. I think the volume of the 7As is up nationwide, or
Not for the larger dollars.
yeah, not for the larger ones. So
Well, think of the 7A being mostly prime plus, say, if you see anywhere from 2 to 275, 3% over prime right now, obviously the 504 is going to be a way better product for a long-term fixed asset.
What spread was that?
yeah, there, and full honesty, the SBA is waiving the guarantee fees on 7As up to $1 million for this fiscal year. Again, that doesn't always help with the rate, but there are some lenders who are doing some low fixed rate. And if that's the best thing for the borrower to do, again, looking at their overall needs and putting the right thing, like when you look at a loan versus a line, what's the right way to finance something? So on there. So with that. Okay, so this is case study of a ground up construction gas station that is hopefully going to be finished up pretty soon. Gas station C-store. And the borrowers, through partners, they had collectively had several 7A loans and they were at their $5 million. They have this new project. So this is where we went, we did a 504 green for them. So the total project and then our gross debenture, including our fees, 1,968,000. So they can keep going with the 504 green. They can do another one and another one and another one. They can't go any more 7A, but they can continue to go with the 504 and they have much more eligibility left for them. Now, I will say that we did this one before the affiliation rules changed. So maybe some of those that we had to include as affiliates with the 7As may not be affiliates these days, so. And then Ed, you've done a number, you've done some hotels and so forth.
Yeah, the hotel's obvious one is where the borrower had, and we always look for hands-on ownership and borrower with, real equity in the project. And he had entitled land in West Sacramento and came back for construction, worked with a third-party lender, and we did it. He put 20% down, but we also did the green, and that was I want to say it's just about $17 million product. So the other part about the green is that and the debentures is that we're not afraid of looking at $20 and $25 million products. The SBA does look at them a little bit more carefully. The thing that we really like to, well, since we're on that, the next slide has to do with the NICS code of 31, 32, or 33 manufacturers. There's no cap on the aggregate, and it's $5.5 million per project. Again, ground up, we can go to the bigger sizes, and it gets back to that size limitation of the business. And there's very, very few, over 40 years of lending, having been in regional and small banks and even big banks, having somebody walk in with $15 million tangible net worth and an average profit of over $5 million a year just hasn't happened. So keep us in mind for the, any kind of those products, especially manufacturing right now.
Thank you. So again, as Ed said, that we can go up to 5.5 million per project for manufacturers in those NAICS codes that have all their production facilities in the US. So there is no cap on the aggregate like there is on the green. Of course, we still, as business gets up to that size, are they still meeting the definition of small business per the size standards on that? But this is great. They want to have, multiple locations for their manufacturing in the US. And always remember that once we've done, so we are licensed to do business in California presently. So once we've done one project for a borrower here in California, we can continue to serve them even if they have out-of-state projects at that point. So this is a particular one that we did in Corona. Jaime, this was one that you worked on. So this was a manufacturer and they already owned a building. They had a small 504 on it, not too big, but they did have that and they weren't paying that off. So they were making a purchase of 25 million. They were also doing a 1031 exchange, I think. So they were putting a little bit more down. But with the bank was able to provide almost 15 million on that. Our second TD, we went to the max gross debenture at 5.5 million. And when I said, so the net that the bank did on their second, we maxed that out was 5,351,900. And so this business, we could continue to finance more facilities for them because each of these manufacturers are standalone projects. Maybe the next time they're going to do some equipment, we could do some 504 equipment. So we can continue to assist them with 504 as they grow. Okay. Can you use a 504 to refinance a 7A loan? So I still get these questions every once in a while. It was a permanent change made in July 29, 2021. I know that during the CARES Act and all of those, there was a lot of noise and it's sometimes hard to remember what was permanent, what was temporary. So yes, that was a permanent change that allows us to use the 504 to refinance 7A, another 504, even USDA. So, but again, always keep in mind that it may not be every 7A loan. We're looking at 7A loans that financed long-term fixed assets that are eligible for the 504. So you have to have eligible fixed assets under that. So the debt also must be qualified. And this is another change they recently made. So we're looking at the original acquisition debt or the original, whatever the original construction debt may have been. That 75% or more of the loan proceeds were used for the acquisition or improvement of that eligible fixed asset. That used to be 85%. Now they brought it back down to 75, which should open up more. So, for example, somebody purchased a car wash. And as long as 75% of those loan proceeds went towards the eligible real estate and equipment, and less than 25% went towards, say, intangibles such as goodwill or inventory, then we can proceed with that. But if it was less than even 74.99% for the fixed assets, we cannot proceed. So now if that loan, that would be if we're looking at refinancing the original debt here. But if it's been refinanced one or more times, we still go back and do this test based on the original loan, their original financing. So that's why we're going to ask for some of those documents and to show that it was used, the original financing was used for that 75% or more test. This test must be done for all types of loans that were refinanced, whether it's conventional, private, or 7A. So we need to do that. And then we're going to look at the existing debt is the most recent financing of the original loan. So depending on whether we're financing the original or financing a refinance of the original, we'll take care of that, doing that test. Jaime is very good at it. He's done a lot of that.
And one of the pitfalls right here is when the original 7A was used to acquire the business and the real estate. And that's where that 75-25 comes in really important.
Right. So if the original debt was a 504, we usually don't have a problem because we know it was all 100% on there. So, but we'll take care of that. We just have to get the documentation. So I've included in here, I don't know if we need to go through this, but these are just some of the basic tips about the debt refinance without expansion. Just keep in mind that we can refinance conventional seller, private, hard money loans along with the 7A and cash out on the equity for eligible business expenses, which I'm going to describe shortly. Debt must have been used to acquire or improve an eligible fixed asset, which is typically going to be owner-occupied commercial real estate and or capital equipment. We talked about our maximum loan to values would be 90%. It's a strict refinance, no cash out. 85% if we're using cash out for eligible business expenses. Cash out is limited to 20% of the appraised value of the eligible fixed asset, the collateral. Debt to be refinanced was incurred not less than 6 months before the application. So the loan has to have been in place at least 6 months. It was incurred for the benefit of that small business seeking finance. So if they purchased a property 5 years ago, but that business didn't exist at the time and they were renting it out and then they just formed the business, that is not going to be eligible. So the business had to have been in existence. The loan must be a commercial loan. So think about like a trucking yard that goes and buys a big property that has a house on it. Maybe they just go and get a consumer residential mortgage. We cannot refinance that. And that even applies to the fact that if the original loan was a residential mortgage and they have subsequently refinanced it into a commercial loan, we still cannot do that. It goes back to the original financing. So if it was financed with a residential mortgage, we cannot assist with that. Operating company, again, cannot be a new business. So even though the debt only has to have been in place 6 months, the business has to have been operating and generating revenue for at least 2 years. And that test that on if they had purchased a business, we had that, we had to have them wait, and we have to show 24 full months of financial statements to show that they've been operating that home. The refinancing of debt, any federal loan, we have to show that there's a 10% savings on there, and we'll take care of that. That test does not need to be done for conventional or non-federal debt. And when we're making that 10% savings calculation, we do have to include any prepayment penalties, subsidy recoupments, and fees on the existing debt. Obviously, if they're taking cash out, we don't have to factor that into savings. How much cash out may a borrower get with the 504 debt refi? And what can they use the cash out? So I get this question a lot. So again, 20% of the collateral value is the maximum cash out, but we also have to back in and make sure they're not exceeding 85% loan to value on the collateral. So cash out may be used for eligible business expenses, or also known as an EBE. And I apologize if we use that acronym too much, an EBE. You hear that. That is business operating expenses that are incurred but not paid, that will become due within 18 months. These are the things that show up on your P&L as standard operating expenses. It's your rent, which could include the rent between your holding company and your operating company. It is wages and salaries, and that does include owner salaries and 1099 employees. That would be utilities, inventory, raw materials, advertising. So almost anything that is an operating expense for that company. You can also use cash out proceeds to pay off or pay down a business line of credit or business credit cards. Again, we're not refinancing that line of credit, so that's not part of the refinance structure. It would be part of the cash out proceeds, could be used to pay that off. It cannot include other term loans. So let's say they just had an unsecured or a UCC filed term loan that was not secured by an eligible fixed asset. I cannot use cash out proceeds to go for that or part of the refinance. Also, ineligible uses would be capital expenditures. So you can't take cash out to then renovate the property. We need to look at how we can use the 504 in another way to do a renovation. Maybe we're doing a refinance with expansion, which would include refinancing and doing the construction, or maybe we're doing a 504 behind the existing financing. So there are ways that we can do that. Obviously, cash out in the business cannot be used for personal expenses. It is not to go buy a vacation home or another property. It's not to be used for business acquisition or partner buyout on there. So when I talk about those capital expenditures, it's nothing that's going to be capitalized on the balance sheet. They want the cash out to be used for operating expenses. However, Ed, do you want to talk a little bit more about that?
Ed, you're muted.
I'm getting over a cold, so I muted myself. I coughed and choked. The eligible business expense, there's banks look at it like when the debenture funds that the bank has to have some kind of control over those funds, and they don't. And it's 100%. The borrower has certified that they're going to use the funds in a certain way. And so really the bank should step away, let the borrower have the money. The certification by the borrower saying that they're going to use that to meet their ongoing operation costs, that allows them to use the income coming in to be used for other things that they might want to do, such as, capital expenditures, whatever they're doing with that. In the event that SBA ever decides to go back and audit, they really should show what they use the money for. And that's where I kind of get back to saying that look at the largest expenses and use that first. Salaries tends to be very high, utilities, even inventory. So just know that it is cash out, it is working capital, but there's a couple of nuances on there where the applicant could be called upon to justify the use of those funds. I haven't seen it yet, but it could happen.
Thank you, Ed. So, will a borrower be required to have a lien on their home with a 504? Ed, you like to take that one too?
Sure. The answer is no. We definitely do not look at leaning anybody's personal property. SBA 504 only takes a security interest in anything that's being financed with loan proceeds. So on the real property in California, it's a deed of trust, which takes into the fixtures that building needs to operate. If there's FF&E that's contributory to values, you know, a hotel would be a good example of that, where you have to have the beds, TVs, desks, all that sort of thing. So yes, we will take a interest on that, but no, we don't go after the home immediately. There's been times where there's when you're looking at a refinance without any expansion, you're going to look at the fair market value of the real estate asset being refinanced. So that's where there could be a potential shortfall where, you know, if something's going to happen to that property that's going to make it better down the road. Let's see, I've been at this for over 12, 14 years between working at the CDC and this. I saw one deal where we ever actually had a refinance with a shortfall. And when that's sometimes where you'll see a shortfall more often than not, is that the economy has changed. Maybe that property value dipped a little bit, and when you come back to refinance, you're kind of like, oops. So a few things can happen is the lender that you're taking out can kind of go, hey, thanks, we're going to forgive that other portion. They could make other terms and term that out separate from the real estate, and that would work. Or you could always look to eligible collateral to make up the shortfall.
And,
So.
you know, working with your CDC, that, you know, it's possible that we could go in after the loan's been seasoned, and if we can demonstrate, you can demonstrate that the collateral value is increased enough, we may be able to release that lien down the road. So.
And one more thing along this is we get a lot of 7A loans being refinanced that did take somebody's primary residence. And if there wasn't a collateral shortfall at the beginning, we've been successful in having that removed from the 504 refinance, which is huge to a lot of borrowers.
Great point, Ed. Thank you. Okay. Can the 504 be used to finance required hotel PIPs, property improvement plan? Adam, I'll let you take this one.
Heck yes. The average hospitality owner, even though they take the huge write-off for depreciation year after year after year, they don't take that money and sop it away for the PIP, project improvement plan. And so to be in compliance with their franchise agreement, there's certain upgrades every so often that like a tier 1 franchise is every 7-8 years. They're going to pretty much redo the interior, and it can be a very substantial amount. Most of what I've run into are in anywhere from $3 to $5 million, and that can be financed within the 504 as an expansion per se. The other way of looking at that is that if they're going to try to control the PIP on their own, if you can fit into the cash out for eligible business expenses, then they have something where they can actually say, we're going to pay for my operating costs with the cash out from this, and the cash flow that comes from the business will go towards the build out. The thing that allows the bank and SBA to do at that point in time is share the amount of debt 50-50. The SBA just cannot be more than the bank. So it's like 40-40-20. So.
Thank you. I know Ed has a lot of experience with hotel financing.
And I love them, so bring them.
Okay. Can you use the 504 to finance equipment only without any real estate? Ed?
Oh, yeah, okay, I'll do this. Of course you can. There's the benefits here are pretty good. We don't do anything called rolling stock. So if it's got wheels, pretty much forget it. But a couple of cases where I've worked with was there was a entity in Southern California that made airplane parts for government, the high tech like the F-35s, and they had used equipment. And somebody said, "Well, can we refinance that?" And the answer was yes. And they were going to retool for something. They had the money to do that, but they didn't want to use it. We refinanced the equipment and gave them full, we had an equipment appraisal done that laid out the economic life that remains in the equipment. As long as that was over 10 years, we could go with the 10-year debenture. If we have something that says that economic life is more than 20 years, we can go with the 20-year debenture. And in that case, we were refinancing used equipment with cash out. That worked. Going back to the borrower I talked about earlier is that, they had the real estate there. And once the real estate was paid off, excuse me, my dog's going wild on something in the background, but if you can hear it, I apologize. Now my other dogs, sorry. Year after year, we've gone back and some of the equipment that they've purchased is between close to $1.7 million to $2.2 million. So on each one of those transactions, it's a separate transaction just for that piece of equipment. What happens is the bank takes a UCC in a first lien position, SBA gets a UCC in a second position. So we're all the financing can also include the purchase of the equipment, taxes, and any kind of shipping and installing. An example there is a commercial laundry bought some what they call ironer systems. They're made in Germany, and so the equipment had to be fabricated, put on a ship, shipped to Oakland, moved from Oakland to Sacramento, then installed, and then so the bank worked with them, made the progress payments, the equipment's in place, SBA funds. New equipment, no appraisal is required, which is kind of a cool thing. So things can go very fast with that.
Yeah.
Excuse me, I got it. I gotta go deal with my, I'll be back.
Oh, yeah, just, again, when we're financing the equipment, you can include
What's going
sales
on?
tax, shipping and installation.
Quiet.
And then again, as he mentioned, if they're purchasing used equipment and it's through a qualified dealer, we can probably just use the value of the invoice price. And not need to approve an appraisal, but if it's gonna be used equipment from anybody other than a dealer, we're gonna need that equipment appraisal. Also, on a refinance, sometimes, I mean, obviously if the majority of what we're financing is equipment or is equipment only, we may need to get that appraisal on that. However, recently they made some changes that if was included with the real estate financing originally, and now the real estate provides sufficient collateral coverage to include the refinance of that equipment, we don't necessarily have to get the equipment appraisal on there. So that is a really nice thing. And then again, equipment appraisals do have to be done on site. It will not take desktop appraisals. We've had some that were ridiculously small amounts, so that's why we're that change is going to improve on that. The appraisal must be dated within 12 months of the application, just like we do for real estate appraisals. All right. Oops. All right, my screen, there we go. Oh, what are the citizenship requirements for an SBA applicant? Again, this should be the same for 7As and 504s. I do still get that question quite a bit. So there used to be a way that if it wasn't, you didn't have a US citizen or a lawful permanent resident, there used to be some way to bring in another person. I honestly didn't work into that. A couple of years ago, they made it actually just very simple. The business must be owned or and operated and controlled by 51% or more by a person or persons that are US citizen or lawful permanent resident. If we don't have that, we cannot proceed. So that is the same for 7A. So I know this is a lot of verbiage here about foreign nationals, so forth, but the simple rule is we're looking at the business, 51% or more owned and controlled by a person or persons who are US citizens or lawful permanent residents. So if they're not US citizen and they are lawful permanent residents with a green card, anybody else who is not citizen, we're gonna have to go through a process of getting a copy of their documentation, having them sign a form, and we do have to submit that in for a check as well. It's a very quick check, so it's usually not an issue on that. So does come up.
And just also focus on the operating company. I had somebody, when the rule changed that year, somebody came back and said, I own 51% of the EPC. It's businesses renting to this other company, and that doesn't work. It has to be of the operating company.
Very true, thank you. Can the 504 be used to finance a partner buyout? Yes, as long as it's, what we're looking at is for long-term fixed assets, such as the building and equipment. So they own, Jaime had a situation a few years ago where two brothers, they had owned the business together and they owned the real estate together. The one brother had already sold his interest in the business. Now he wanted to get out of ownership on the building. So we can definitely accommodate that. The change of ownership must be between existing owners, so we can't bring a new owner in during that. So it has to be just we're getting one owner out and not bringing anybody else in. So all buying owners are existing owners prior to the buyout. Remaining buyer owner keeps all equity in the project. There's no additional cash out for operating expenses. So for example, you have 3 people who own the property, 33.3% each. One of them wants to be bought out. Property is worth $3 million and they owe $2 million. So we're going to refinance that $2 million. They each have $1 million, so there's $1 million of equity. So they each have $333,000 of equity. The 2 that are remaining will keep that equity in the project, and then we take out the $333,000 to pay off the other one and refinance the existing debt, and that would be our project. The selling owners must be completely divested from all ownership interest and management activities for the small business concerned. They cannot remain an officer, director, or stockholder or key employee of there. So they need to be divested from that. So again, the 504 on a partner buyout only finances the costs associated with eligible long-term fixed assets. It's not going to include any intangibles such as goodwill. If there's part of that, that could be handled in another form of financing, such as the 7A that could be done for the business. Interestingly, if you're doing a partner buyout and we're on that building, and they also want to, taking out the existing debt or paying off my partner, I also want to do some improvements to the property. Yes, we can include that. Because then we're looking at, so for the buyout, we're looking at the as-is value. Then we would get the as-completed value also to do the improvements. So that is eligible to do at the same time.
We should note the 36 months as well.
Pardon?
Only the real estate for 36 months.
Yes, they have to have owned the real estate for 36 weeks. Thank you, Jaime. Thank you. Before we can do that. Okay. All right. What are the lease requirements for properties financed with SBA loans when the borrower holds property in another entity, which we call an ETC or eligible passive company, an LLC trust, something like that. So I think that's probably the same for 7A. So the operating company and EPC master lease requirements are that the term of the lease between the two, including renewal options, must be equal to or exceed the debenture term. So if we've got a 25-year debenture, then the lease needs to be at least 25 years, including, but it could have renewal options in there. The operating company must lease 100% of the subject property from the EPC. Any third-party tenants will then sublease from the operating company. That is the rule of the SBA. So the third-party tenants cannot lease directly from that EPC holding company.
EPC is the borrower. and-
Yeah, so they're technically the borrower, the passive company is the borrower on there. And then, of course, the guarantor is the operating company, yeah. So rent, and then rent payments, we're gonna look at that very closely. The rent payments cannot exceed an amount sufficient to service the debts of the first and the second TD loans. So on a 7A, there's their first, plus enough in terms of the expenses related to the holding the property, such as maintenance and insurance and property taxes. Kind of a rule of thumb is take the loan payment amounts of the first and second to 125%. That's usually kind of a rule of thumb that we work on. The SBA does not want to see excessive rents charged to the operating company so they go back into the pockets of the EPC owners, because their EPC could have owners that are not part of the ownership of the business. That is allowed. Now, this is a really big one that we see. The EPC may not engage in business activity other than leasing property to our subject operating company. So we get, and this was a rule that happened about five or 6 years ago, and it is very strictly adhered to. So sometimes we have a borrower coming to us and they're purchasing a building for their business. And they say, I already have this LLC. Yeah, it holds my apartment building and some land that I have. Well, those are not used for that business. So that EPC is not eligible to have to form a new one that would be. So, but let's say they had another property for that same business and that was in that EPC, and we're going to use that for the next property for them, and they're going to keep operating and it's not going to turn to a rental, then yes, we can use that same EPC. The reason the SBA is very strict on that is that, let's say you had an apartment building in there, and there was a lawsuit. Because of the holding company, you could entangle our collateral plus the other. So the SBA does not want to have that. So, and then EPCs that are owned by a trust, the trustor must guarantee the loan, and the beneficiary if it has control over the trust. So, and then when we're looking at those size standards, trust itself does not have to be small by the size standards. So we're not factoring that into when it comes to a trust. Ed, did you have anything to talk about with the leases?
No, it's pretty straightforward. And the other thing that is very important is if there is an existing EPC, that if you go in for another loan for the operating company, there's the EPC is going to be tested for its compliance and adherence to the guidelines of the SOP. And I found where that has not happened, and either they've paid themselves too much, and then you go, why have you done that? And they went, well, we weren't totally aware of, that we can get them to sign a compliance agreement. In another instance, they paid themselves more money knowing that they were going to go into this construction project, and they actually had those funds set aside for the equity required for the next project. That's good. So if they have an existing EPC, just know there's going to be one more litmus test to getting into approval.
So we, as a CDC, we are collecting financials annually. We're going to be looking at that to make sure there is adherence to those guidelines. Usually where we see what Ed said, that somebody, not to put it out on other lenders, but they had a 7A or another 504 from a long time ago before this rule went into place and was so strictly adhered to, that they really are just like, hey, nobody told me. I didn't know that. So now it needs to be adhered to. So, but we'll try to work with you to figure out a way to get and move forward if it's not compliance now. Okay. Okay. Do 504 loans take a lot longer to process and approve than other loans? I'm gonna say now if we work together. So Ed, I'm gonna let you talk about it, and I'm just gonna say, this is an amazing thing. We submitted a loan after 6 o'clock last night. We got approval before 9:30 this morning.
So,
That was like a record. So,
so, but that, in all fairness, that wasn't the case during the pandemic.
no, it was not.
Which is fair, I can understand.
Right, so let's not confuse what happened in 2020 and 2021 with record volume hitting the SBA. The poor Sacramento Loan Processing Center trying to staff up, being, they were also trying to work on work at home, having, technical issues with what they were doing, illness hitting them as well. So yeah, that was a tough time.
Sure.
That was a tough time, but so much more improvement. Of course, volume's down.
What was the complexity of the deal you submitted?
It was
Just
not-
straight purchase. It's the idea there is it's very simple.
Yeah. But Ed, you want to talk about how we can make sure that we're not taking longer?
For sure. The CDC works much in the same fashion as a bank does. We have, we take the loan in, we do the underwriting, we give it to our underwriters who tear it apart, break down the onion all the way to the last little leaf, and then put it together. It goes to a loan committee. Loan committee gets its, blessing. It goes to SBA for the terms and condition issuance. That's why it's very important. Pull us in early, and we'll work in tandem with you. A lot of lenders have thought that they should go ahead and get the loan approved, then go get the SBA, 504 approval, and it's really almost the other way around. I'll tell you, we can get the SBA approval a lot of times quicker than banks, and that's in my history, that goes a long way with credit administrators saying, "Oh, okay, this is okay deal." So during an average commercial real estate purchase in the last, good God, 40 years, people go, you'll get some residential people thinking, God, can we close in, 25, 30 days? No, Ronnie, the commercial appraisal is going to take 3 to 4 weeks, unless it's a dead time in the market. Environmental stuff's going to go on. There's going to be questions. So I tell borrowers and bankers that, there's going to be a lot of activity in the first 2 weeks. Then there's going to be this lull, maybe 2 weeks, maybe 3. And then when it comes to bank closing, if it's a straight purchase, we're going to have concurrent documentation signing. Boom, we're done. If it's a construction deal, it's going to be a little bit different where the bank's going to close. SBA is going to be there. We're going to be more of a takeout lender. So the overall true credit process is not very long. So we could have an approval subject to appraisal. We can have an approval subject to environmental. You can have an approval subject to appraisal and environmental. So if you're looking for a level of confidence, we can do that. So, but it shouldn't, if you have contact with the brokers out there, a lot of times they're going to set you up for a 60-day escrow close. And it's human nature to, once they have the purchase contract, to sit on it. I mean, we've had stuff where it comes in and you go, okay, you got a 60-day escrow, and you go, this PSA was, executed 30 days ago, so make sure you have control of the deal. Get in early, get it to us, and we'll help you.
And please know that we do not purposefully drag our feet on trying to fund our debenture. We are doing everything we can if it's a straight purchase, to get what we need to fund as quickly as we can. And on construction, we're trying to get this done. We don't earn money and get paid for all our hard work until we fund. So we want to fund. We are not trying to drag our feet on that. So please know that.
And what Janine's saying is that's where we're going to ask the questions that SBA is going to ask. And I've learned in the past, that, I've been kind of shy about asking. I go, do you have any outstanding, felony convictions over the past? Tell me now, because we have to go to Washington, D.C. to get an approval for you to get the loan. Do you have any, anything that's going in current litigation? Are you in the middle of a divorce? All this kind of stuff has come up over the years. So the more information we have, we're not looking to go, oh, I got you, we're going to decline your request. We're going to go, oh, we have another hurdle. Let's get over that to get you an approval.
Okay, I've got one more, truth or myth. All CDCs are the same. I'm just gonna jump in here and say, we say that is a myth. So Ed, do you want to talk about that?
Sure, it's definitely a myth. I always say that the 504 program is a one-trick pony because you're going to get pretty much the same terms and everything at any CDC you go to. What really makes the difference is the person and personality of the CDC you're dealing with. A lot of them have the kind of ego that they're the biggest, the best, where they have a BDO that comes in and says, yeah, let me take a look at that. And then they drop it off to a loan officer and back off to the golf course. Our people are hands-on all the way through the process. We have a dedicated team, which each business development officer and 504 specialist has. We have a processor that works with that loan officer. We have underwriting staff, and it's first in, first out with that. And I have 100% belief in quid pro quo. You bring us deals, we're going to look to bring you deals back. You know, and when I've worked with somebody I think is probably on here too. It's like I was looking at a loan, and we just couldn't get there with the $504, and there was 2 other business loans on there that, you know, if they did the 504, their underwriters were going to go, no, we're not going to do this deal. And I said, well, why not go, you know, I hate doing this, really. I hate losing a deal, but helping a borrower. I said, go back and do it as 7A. The bank has the ability to price their 7A however they want. And when they went back and put those 2 deals, those other financing within the underwriting, it made the debt service fall into place. Everything's good. Borrower's happy, bank's happy, you know, and we helped out the borrower and the bank. So, you know, our day is good. The other thing that you'll find with AmPac is we do our due in the communities. You know, very active in Southern California. In Northern California, Ronnie has put together a few times where we've worked at the food bank. We've done fundraisers. We've done just different things like that. So, you know, the other part that differentiates a lot of people or us from another is the knowledge of the SOP. You know, knowing where the tripwires are, government financing, while it sounds simple. The example I always give everybody is everything flows back to the Code of Federal Regulations. And the number of pages in the Code of Federal Regulations that deal with the CDCs is 13 pages. We have close to 450 or 500 pages of SOP. So, you know, it's interpretations that really, and those kind of get nuanced every so often, like Janine is saying, is that, you know, they come and they go, well, you have to have 3 $5.5 million projects for the green. Maybe not, you know, okay, we'll do multiple ones, but you got to tell us. And so things get changed, and it's the people that stay on top of that can help you win the deal. We'll get out there, market with you. We'll get out there, go on business calls with you, and build that trust and relationship. Many of our relationships become friendships as well. So that's kind of in a nutshell who we are.
Thank you. So of course, as we stated up there, is that all the terms of the 504, the rates and the fees are all statutory. So every CDC has the same, but it's really about the people and the relationships you build within your CDC, and how does that working for you? And trust is a very important issue with that. And I think some of you know what I mean by that. We have had an issue on there. So
I will guarantee you, if you bring a loan to us, it will not show up in another bank's pipeline.
until you say, hey, we're not going to be able to do it, but will you help my client?
Yeah, right.
So,
But we will tell you if the borrower is talking to another bank. We're not going to share and compare term sheets with you, but we'll, you know, communication and trust is where it's at.
So I do see one, opening it up for Q&A, please, put something in the chat if they can raise their hand in there.
They have access. to
Yeah,
it.
you have access to do that. So Nancy, I see you have a question here on ESOPs, and I'm telling you, I was gonna put an ESOP slide in there, but I thought I was getting into too much. So yes, ESOPs are eligible, and I will, because you added that before I send this slide deck out, I will add that slide in there now. So ESOPs, it's not frequent, but an ESOP can be on that. Now, you cannot use an EPC OC structure, a holding company with an ESOP. So the entity will have to own the real estate directly. And then, let's see, if the business is 100% owned by the ESOP and there are no owners outside of the ESOP, oddly enough, personal guarantees are not required. But if anybody has ownership outside of the ESOP, they will need to guarantee. So, and that would typically be somebody in a management controlling position anyway. So I will get those details and I will add that in there. I knew I was supposed to, so on there. Okay. Sheldon, if we are purchasing a building that will be purchaser occupied over 51%, but has existing tenants, do those lease return tenants benefit the approval process? You're talking, I'm assuming you're asking about whether or not we can include the rental income in the cash flow. If that's your question, then okay, yes. No, we're not able to include rental income in the cash flow. The business needs to be able to support that on its own.
However, when you do a credit presentation, and I've done this where, our reliance upon meeting debt service is purely on the OC, and the fact that the tenants in place cover 74% of the debt service, we're going to ignore that. So,
Yeah, there's things that we do that, so some lenders we work with on the first TD, they may be able to include it, but maybe they have a higher LTV requirement than we do. Maybe there's some things we're looking at differently. So sometimes it kind of all shakes out anyway on there. Okay.
that also gets back to the banks are going to historically look at underwriting commercial real estate for an investor versus an owner occupant.
Do we have any other questions? Anybody want to be unmuted for a question? Okay. Well, so here is our team here. So we have you covered from NoCal to SoCal, and we have Ed, Brian, and Ronnie Sylvia are up in Northern California in Sacramento. And then here in Southern California, be myself, Jaime, Eric Iwashika, and Eric Ebel. So contact there, that will be in there. And as we say, it's always 504 somewhere. Look for that. And so we are ready to serve you both on our community lending and our 504. Happy to answer any questions anytime. If you did not register and we don't have your email, please feel free to send, and you can go ahead and send me an email at jwarren@AmPac. A as in Apple, M as in Mary, P as in Paul, A as in Apple, C as in Charlie.com. And I'd be happy to send you the presentation on there. So we really, looks like we're just 3 minutes over. So we appreciate your time and thank you for joining us.
Great job.
Thank you.
Thank you.